Hey everyone, welcome to the December Markets Monthly. I'm Doug Huber, the Deputy Chief Investment Officer at Wealth Enhancement Group, and I'm excited to be joined by Aya Yoshioka, our Director of Portfolio Consulting. Exciting month here in December. A lot of things going on that are behind us. A few kind of new things coming, new information coming online as we speak, and so we're excited to kind of give you a rundown of what's been going on in the markets. Maybe if we just move one slide forward here. At a high level, we've had a really strong year in the equity markets, and November was definitely the pinnacle of that. It was a really strong month on the back of the election, and the markets were on pace to finish off a consecutive year of gaining at least 20% for the first time since that 95-98 stretch. And so it's been a really good run for the equity markets over the last 2 years. I think with the decisive and clear election results, the market has started to price in the opportunity of what a new administration might do. And this has really brought a lot of tailwinds to the markets, and what we'll call animal spirits of people excited about what kind of growth we can expect. I think that is also on the heels of a relative tailwind from the economic conditions, especially here in the United States. The data is relatively positive. Our consumer is incredibly healthy, and that kind of really it leads to a lot of complications as well as strong backdrop. And so I think today we'll talk about a lot of those. I think in front of us, the big decision here is what's going to happen with monetary policy. What is the Fed going to do? And I think they're trying to juggle that same information. Most recently, this last week, the Fed came out with their latest decision to lower rates by 25 basis points. But on the back of that, had some less than desired nomenclature around what might happen in the future. And I think the wording they used spooked the markets a little bit. It made the markets think that maybe the path for more rate cuts wasn't as certain as they thought it was. And the potential for actually rate hikes at some point might be closer than they are farther away. And so I think the markets had a sharp sell-off on that. We also are, currently in the midst of a potential government shutdown. Those discussions are currently going on, and hopefully there will be a resolution. Although I thought I saw some interesting data points today that in every other case that this has happened, actually the forward 3-month return, regardless of kind of the uncertainty, ended up being positive. Now, that's not to say we're predicting that, but I thought that was interesting that despite uncertainty, the markets actually rally off the back of these decisions typically. This morning, we also got some good news as it relates to the PCE, a great gauge for inflation that I know the Fed looks at. It came in a little softer. And so that, the markets are now back to thinking, hey, maybe this inflation issue is under control. Maybe the Fed will continue the pace of rate cuts at what was predicted. And so all of that's being juggled around. And so I think over the next few minutes, myself and I will run through some of the backdrop of kind of what the Fed's looking at, what we're looking at as we think about, what is the true economic health, and where do we want to be positioned in our portfolio. So with that, I'll probably throw it over to Aya, and maybe you can give us a little bit on the markets.
Sure. Thanks, Doug. It's a great setup here. And, I'm going to take you back a little bit in terms of where we ended the month of November. And from a year-to-date perspective, as Doug mentioned, it's really nice to see all of these positive returns. Many of these numbers are in the 20% plus range. So great to see that across all the U.S. equity markets here, whether it was U.S. large cap or small cap, growth versus value, really strong double-digit returns on a year-to-date basis. From a outside the U.S. perspective, the returns have been a little bit more moderate, in the single-digit range. And after the election in November, a lot of these international regions sold off a little bit, and a lot of that has to do with the strengthening in the U.S. dollar. We've seen the U.S. dollar really strengthen over the last few months. And that continues to showcase just the relative value proposition that we have here, with our interest rates being a little bit more elevated relative to other regions, and just the overall strength of our economy. And then from a fixed income perspective, again, we're seeing some moderate returns. Starting yields are always a great place to forecast what returns could be in the fixed income realm. But we also look to fixed income to see whether or not there's any stresses that are building up. And I'll be going into a chart on that shortly. But, overall, we're seeing some positive numbers here in fixed income, despite some of the volatility that we've witnessed in fixed income and overall yields in 2024. But good numbers here across the board, whether it's the core side of things, munis, short treasuries, all positive numbers here. And then commodities and REITs. Again, REITs have had strong double-digit returns despite the fact that interest rates have stayed elevated, but it's really been helped out by the fact that interest rates have been expected to come down. So with that, I will go to the next slide here. That is really a global equity heat map, and we actually bring in some of the 3-year returns here. It's a nice colorful way to show sort of all of the returns, both on a shorter term basis as well as a little bit longer term basis. And then what I'd like to point out here is really focusing on some of the 3-year numbers over to the right hand side. And the top part of this showcases US large, mid, and small. And really over the last 3 years, it has been a US large cap game. And, we're starting to see a little bit more participation on the, more recent numbers with small and mid cap. And that means that equity markets are broadening out, which is really nice to see. We don't want to see all that growth and returns concentrated only in the Mag 7, as we've talked about in the past. And then, looking at this sort of globally, internationally, as well as from an emerging markets perspective, this is just a nice way to see things from a heat map. Where are we seeing the returns? And again, as I mentioned, international and emerging markets have had a little bit of a tough go, both from a near-term perspective as well as on a little bit longer-term basis, simply because, the US economy really continues to show its resilience. And this is something that, the investment team has been talking quite a bit about. Doug, do you want to sort of maybe add some of the color that, we've been sort of debating within our investment team?
Yeah, I was gonna ask you the same thing, so I'll take it. But yeah, no, I think, listen, if you look at this, it's a very fair conclusion to draw of, okay, why would we be anywhere else but the United States, right? And I think, there are reasons. Obviously, the U.S. has been the dominant market for several years now, right? And you can see in those 3-year numbers far outpacing either a global benchmark or especially international dedicated or EM. And so, why do clients want to hold these other areas? And I think we've looked at it from a lot of different perspectives. I think first and foremost, the reason to hold them is for diversification. There are a lot of great businesses that are, domiciled in other countries that might have revenue streams that don't necessarily come from those countries or those economies. And so what we try to do is really get granular in how we think about our exposures. And we've looked through, and even if you look at the S&P 500, a great proportion of it, actually, the revenues generated inside of the S&P 500. So all U.S. domiciled companies, 40+% come from international and emerging markets in terms of where the revenues are generated. So just because you own companies that are domiciled in the U.S. doesn't necessarily mean your exposure is just to the U.S. economy, and vice versa. Much of EM listed companies and international developed companies garner revenue from the U.S. as well as other regions. And so we think about it not only on a domicile basis, because that can oftentimes be how things are priced in shorter term, but we think more for the longer term, where are our revenues coming from, and do we want to be exposed to those economies driving those underlying revenues? And so we understand, if you were to look at this just at face value, why don't we only own the S&P 500? Because large cap's the only thing that worked. But to your point, we are seeing a broadening of the market. We have seen some outperformance in small cap recently, and I think that's on the back of what some of the projections going from here look like. I also think, though, that the U.S. dollar has been very strong. That generally hurts international and emerging market returns. But it's not to say it always will be, and we've had long periods where it hasn't been. And so we are thoughtful. We tend to have a little bit more of what we call a home country bias, and so we tend to be a little bit more overweight U.S. than a broader global benchmark. But we still believe there's a lot of great areas to access outside of that. And just because indices do one thing doesn't necessarily mean our underlying investments follow, step by step. And so to us, it's still an area we think there is some opportunity, but we have to be very careful about how we tread. And, we want to be thoughtful about not just positioning for what has worked in the past, but what might work in the future.
Awesome. I think the other, area that we think about a lot is, fixed income. And, fixed income has typically provided signals to the equity market in terms of what's going on from a credit cycle perspective. And so, we like to look at high yield and the spreads on high yield relative to a US Treasury. And that's what you're seeing here in this chart here. And what you see is that during periods of stress in markets in general, you see these spreads really widen out. And so those are the times in which, whether it was the financial crisis or during COVID, or other periods of time, you see that when there's stress in the overall credit market, it does show up here. And at the end of November, we were almost at sort of multi-year, multi-decade lows. And it's come up a little bit just more recently during the month of December, but just a little bit. It's just a slight blip here when you look at this over the long term. And we like to really look at this because this shows that, again, high yield companies or high yield corporates reflect companies and bonds of companies that have very high interest rates on their bonds, and they have to have that high interest rate because those companies may not have the most pristine balance sheet. And so those would be the areas that you would see the stress sort of first. And we're not seeing that at the moment. And then it gets even better when you go up the spectrum in terms of investment grade and higher quality corporates. Anything to add there, Doug?
No, I think, this is always an interesting one from our seat because it is the area that typically will show stress first, and we keep a very close eye on that. The market here is clearly telling us that, they don't see stresses to highly levered balance sheets, which would, to your point, be the first place you'd usually see a crack in kind of a recessionary environment or a slowing economic environment. And so the market on the credit side is saying, hey, everything's pretty good here. And that's even with elevated interest rates. Typically these kind of companies are usually disproportionately hurt by, higher interest rates. And so whether the market's pricing in the prospects for lower interest rates, and that's some of it, whether it's pricing in, hey, corporate balance sheets actually are a little bit better than they have been historically, and they believe that the cash flows to support that debt, there's a good line of sight that those will continue to be there. That's a good sign. It might not be the time that we want to load up on high yield because we don't think we're really necessarily getting compensated to take that additional risk. But it certainly is a reasonable signal from the market saying that they're extrapolating that the economy and these businesses are in a reasonable place and think they will be for some period from here.
Great. And with that, I'm going to hand it over to you to sort of talk about our macroeconomic dashboard and what we're seeing from all the economic data and how this sort of helps to inform both, I'm sure the Fed's looking at something even more detailed, but sort of how we think about just the macroeconomic landscape going into 2025.
Absolutely, and I hope all our viewers have their magnifying glasses for this slide because we've put a lot on here in terms of the visual, but I think we can distill it with more kind of the bullet points on the right. I think if we look across kind of a lot of these economic indicators that we always keep an eye on, and a lot of them are generally good signals as to kind of the overall health of the economy, we're trying to generally determine like which direction are these going? Are they improving? Are they staying steady? Are they declining? Over what period, and what period are we measuring them on? And so, I think for a while now, they've kind of been signaling a variety of different things, none too extreme in any direction, which is always good. But, on the positive side, for the last several years, the consumer has really been the highlight, especially here in the US, whether it's consumption, whether it's income, savings, The predominance of U.S. consumers are in a really good spot. The equity in their homes is much higher than it used to be. They're making more money. They're generally saving more money. And so, for the most part, kind of the engine that drives a big part of our GDP is doing great. Now, we always have to be thoughtful of what could change that. And that's where, you spend a lot of time thinking about the labor situation. And I think, on the labor side, it's a little bit of a mixed bag. Actually, we can go one back. I'll come back to the bigger labor in a second. But generally on the labor, I think it's a mixed bag, slightly probably better than is worse. The ISM surveys, which is the Institute for Supply Management, really that the big one they put out is called the Purchasing Managers Index, and that's essentially where they survey all of the purchasers of different companies around the country, and that's trying to say, like, are you doing more business or less business at the end of the day? And so from a manufacturing side, PMIs are okay. I think things are pretty good. I think post election, we've seen some confidence surveys, especially small business confidence has gone up. I think that's partially to do with just having clarity. We had a successful election. We know the next regime that's coming in. We have pretty good line of sight as to what their policies will tend to lean to. We don't know exactly the magnitude of them, how many get passed, but you have a rough idea of kind of what the Trump administration will lean into. And so I think with that, just clarity in general tends to increase confidence. Increased confidence means business decisions get made as opposed to kind of left on the table. And so that in general is a decent sign for the economy. On the other side, real estate continues to have its own conundrum. We certainly are wildly undersupplied. We've seen new building permits come down, so builders are kind of taking a pause a little bit here, and that doesn't necessarily help affordability of housing. So we're keeping an eye on that. There's many moving parts there. Job openings have been a little interesting, and we'll talk about that on the next slide. And then one index that a lot of people look at is this leading economic indicators, which is essentially a bunch of these data points aggregated into a measure that kind of generally will give a sense of kind of how the economy is doing. That one has been what I will call weakish for a little while now. And so it's trying to say, okay, how do you balance what that signal's telling you versus some of these other signals that are more normally in the ranges of the things are really good. And so it's a bit of a mixed bag, but I think the overall takeaway for us is that as of right now, the data is indicating that the economy is pretty healthy, and we're always looking at the data. So is the Fed, but that's what we're keeping an eye on. And data changes, and it can change fast. But as of right now, I think the overall picture of this visual that you see here is that saying, the economy's doing pretty good right now. To take one more step into the labor markets, I think it has been. We can go one slide on here. This is really what the Fed is focused on right now. I think they feel reasonably good about the inflation picture. Yes, would they like to see it come down a little bit more? And as I mentioned at the beginning, today's PCE number came in a little softer than expected, which is kind of what everybody wants to see. So that's a positive that it was a little under target. And so maybe that will continue to dwindle down, especially as we have year-over-year measures going into next year. So employment is really the area of focus, right? And in that idea of supporting that consumer that I mentioned has been so healthy and keeping them that healthy. And so, I know in prior versions of this broadcast, we've talked about, what's going on with unemployment, the SOM rule. There's been a lot of things thrown around, and unemployment has ticked up. And so that's something to keep an eye on. A good indicator of that is if you don't even look at this data, is just keeping an eye on, what's on the front page of a newspaper. We aren't seeing huge amounts of, companies going out there with massive layoffs. 40,000 people got laid off here. If you remember from prior, whether it was COVID or the great financial crisis, that's all you saw was massive rounds of layoffs. We're not seeing that yet, thankfully. So that is a good sign, but we are seeing it tick up a little bit. The other thing is that these numbers are a little bit different this time around in that, there is an impact of immigration in this country, and how has that kind of how is that getting weighed into these numbers in terms of, is unemployment what it really is, or, is it much bigger or much smaller because of this numerator denominator effect of how much supply of workers are coming in from the mass amount of immigration we've had recently. And so that's where I think the market is still a little bit unsure of, A, do we trust these numbers, and B, are they indicating the same thing they have historically, because it is a little bit of a different paradigm. And so we continue to think the labor market looks okay, but it's definitely an area of focus for us, as well as and more importantly, the Fed and what they do from here. I mean, Aya, would you add anything to that?
Yeah, I was just going to say that, especially more recently, we've had some noise in the labor market data. And we watch a lot of this, we get a lot of weekly information. We get initial jobless claims on a weekly basis and continuing claims. And these are people who are claiming unemployment, right? And so you want to see a lot of that, and you can see the trends in those claims. But we've seen a lot of noise just given, strikes that we've had at Boeing, some weather impacts from the hurricanes. And so it's been a little bit noisy here in the fourth quarter, and I think that'll start to get smoothed out as we go into 2025. But we're going to have to sort of wait and see how this develops. But we're not seeing a huge increase or decrease. The pace of change on these unemployment claims have been relatively small. We're not seeing big increases, we're not seeing big decreases, and that's sort of a nice gauge to see whether or not there's stress in the employment picture.
Yeah, absolutely. That's a great additional thought there. And listen, I touched on this briefly before, but I think, just to reiterate, you can see that this is the household financial situation survey, but this is a very similar graph to the small business survey. Both of them had a very similar result post-election, and that was a pretty marked uptick in confidence. And again, I don't think that's necessarily a referendum on, hey, everything's great because this administration is going to change everything for us. I think it's a referendum more on, hey, we have clarity. We know who's coming in. We have some idea of kind of what their policies will look like. And with that, with clarity, I can make decisions versus, if things are less clear, then I'm more than likely to delay purchases, to delay big expenditures, things like that. And so confidence stepping up in the small business side, confidence stepping up on the consumer side is actually a pretty big positive. And so it can move quickly. Everybody this is a very behavioral survey, and as I'm sure you can all imagine, this can change on a dime, but it is generally trending, especially off kind of 2 years ago, in the right direction.
I would also just add that it's likely a referendum on the overall inflation picture as well, yep. Right? And given where inflation has trended to, the rate of inflation has come down, but I think for consumers, everybody's still a little bit hung up on the actual price levels, right? They're still a lot more elevated than we'd like them to be, and either incomes need to catch up in order to be able to afford a lot of these higher priced items, or we need to start to see some declines, right? Some disinflation more so than anything else. So
yeah,
yeah.
No, I think you're right there.
Yeah. So with that, again, I wanted to touch on what we sort of started talking about at the beginning of this webinar, is just the overall, U.S. versus international and the outperformance that we've seen in U.S. equities over the last, decade plus. I'm going to start with the sort of, chart on the right here. It's the S&P 500 versus the MSCI All Country World Index, excluding the US. And you really see that the S&P 500 has outperformed for a very, very long period of time. But if you go sort of prior to the financial crisis, you can see that there were periods of time in which the S&P 500 did underperform the rest of the world. And one of the things that we continue to debate here is, if you want to lean into the U.S. exceptionalism that we continue to see from an economic perspective, or from a market perspective, or from an innovation perspective, you have to pay up for it. And that's the chart on the left. And you see that, the S&P 500 is at the top right. We've had the most the earnings growth, so almost over 14% earnings growth in the S&P 500 over a long period of time, but the valuation is over 20 times. So it is a little expensive. When you look at the MSCI All Country World Index, excluding the US, you're still getting about 12% earnings growth. So that's still pretty good earnings growth from our perspective. But the PE ratio, the price to earnings ratio, is much cheaper. It's almost 10 points cheaper. So we think that the risk reward from from that perspective is really compelling when you think about just the diversification that could provide and the potential for multiple expansion, for the upside on the MSCI All Country World, excluding the US, and then protect some of that potential downside that might occur in the S&P 500 from a multiple perspective, just from a valuation perspective. So anything to add there, Doug?
Yeah, no, I mean, I love this chart on the left. I think it's just a great illustration that, you're right. I mean, it clearly shows just how strong, US based companies have been in terms of their earnings growth. But, what's interesting about the stat is that it is based on a forward price earnings basis, right? And so that's making an assumption, right, that those earnings do actually continue. And I think this is a great one that can kind of surmise what we try to do on a day-to-day basis. And it's trying to extrapolate, do we think that projection for future earnings growth or for forward price earnings is right? Right. And that's not just for the S&P 500, that's other places as well. And like we said, we do think the US economy has a leg up on the rest of the world. And so maybe that gives us a little bit of a higher probability on revenues generated from the US, but you're paying for that. And so, we do think about, okay, well, what's the probability in these other areas that they can continue to grow earnings, or their economies will continue to grow enough to support revenue and earnings growth in from those particular regions, and what can we pay for that? And so it's a weighing game of kind of bringing all these little pieces together to figure out how do you create a portfolio that balances the risk, that balances the opportunity, and doesn't leave us in just one spot that our projections need to be spot on, or otherwise things don't go as well.
Absolutely. And with that, one of the things that really contributes to a lot of how we construct portfolios, across the board is it starts a lot with monetary policy, right? In terms of where are the interest rates going to be in 2025 as we think about portfolio construction. And this is the conundrum that everybody is in, right? How high do interest rates need to be to reflect an economy that is relatively strong, and not be too restrictive so that we can keep the growth going, but combat inflation at the same time. And that's been the Fed's sort of task for the last couple of years, especially as inflation has sort of reared its ugly head. And the expectations for 2025 were that now we're likely to get 25 basis point cuts in 2025. The market was expecting 3 in 2025, and the Fed had communicated 4 back in September. So we've seen this reduction at the most recent Fed meeting, and we'll see how the economic data develops as to whether or not those two actually come about in 2025, or that whether or not they'll have to do less or perhaps more. And that will depend on that balance between inflation and the labor market and where we're seeing the overall economic growth. And right now, there's a lot of uncertainty on both sides, right? Whether it's on the growth side, there could be additional trade policies that come into play. There's always something that maybe everybody else is just not paying attention to, whether it's geopolitical risk, that always can add to the uncertainty and add to sort of how economic data shapes up. But for the most part, everybody's still looking at 2 cuts for 2025 now, and we're just going to recalibrate for that scenario in 2025. And then lastly, when we think about just stocks and bonds, I like this chart. It's nice to see that stocks and bonds, the correlation is going back to negative territory. And, this is a good thing. We want to see stocks and bonds sort of not move in the same direction at the same time. 2022 was when, the correlation was the most sort of positive. You can see that here by the end of 2022, we were in really high territory here, and that's not great because then you don't get that hedge that fixed income has typically provided, being the ballast in your portfolio relative to the sort of higher risk equities that can provide a lot of the growth and combat inflation. And with that, I'm going to turn it back to you, Doug, in terms of our overall outlook and opportunities.
Yeah, no, and I think this, we'll just kind of wrap up a lot of what we said there. I mean, I think we continue to see the economy being relatively, strong at the moment, and we think, there's increased optimism on the back of kind of a new administration and their expected policies from here. That's not to say there's not risk to it, but I think in general the market has reacted to the clarity and the potential for these future policies. And so we expect, GDP and earnings to kind of continue to be strong through this quarter and, probably through the next couple of quarters as well. I mean, we obviously will look at that data as that comes at us. To Aya's prior point, right? We're balancing where are we with inflation and where are we with the job market. And so inflation is going to continue to be a key focal point. Like we said, that this kind of path to normalization has stalled out a little bit in the high 2%. We did see a little softness this morning, and so we'll see where that takes us. That could be a blip on the radar, or it could be something forming a new trend back towards that number. I think regardless, it's still in a better place than it was, and it still has at least fallen to a point where it's trending in a relatively kind of sideways line at this point. So the concern around it continuing to take a sharp spike up, I think, has been taken off the table. It doesn't mean it won't or can't, but I think, in general, people have accepted that, okay, we'll probably trend sideways, hopefully slightly down from here. But if we do see it continue to heat up or be a little elevated, there's a chance that the Fed reacts to that and that, cuts get taken off the table. And at some point, hikes might be back on the table. All of that kind of comes to the point of the Fed funds path is a little bit more uncertain than it was probably 3-4 months ago. And so we're keeping a very close eye on that. And again, big ones are inflation and jobs data. In general, we think, despite the higher valuations here in the US, it does seem to be a more fruitful area to hunt for opportunities on the equity side. And as such, you generally will see the portfolios be slightly overweighted to US equities relative to kind of their global benchmark. As we've seen, a backup in yields, we're looking at our duration positioning. We're just looking at the curve in general because to Aya's point, fixed income serves a variety of different reasons to hold, one being income, but another one being just kind of how does that hedge your portfolio against equity volatility? And now that things are back to a bit more of a normalized pattern of how equities and bonds behave relative to each other, is there an opportunity to add a little bit more protection, quote unquote, into the portfolio? So we're looking at that and where do we think we're getting paid relative to the risk? And then, I think as so much of the economy or so much of what drives our economy and specifically GDP is from small and medium-sized businesses that are private in nature, we continue to like the private markets for exposure, and that can be across equity, it can be across credit, it can be in hard assets like real estate. But so much of our economy is encapsulated on the private side, and now that we have access to those kinds of investments and the ability to put those into client portfolios, where it makes sense for a particular client situation, we do think the diversification and the return potential there is probably a little bit better than we can get in the public markets. And so selectively picking opportunities in the private markets, we continue to think helps broaden out that kind of traditional equity bond mix that has been popular for so many years now. So I think with that, Aya, do you have anything else to tack on to it?
No, I think that's it. I think I just want to wish everybody happy holidays and a fantastic start to 2025.
I totally second that. And so with that, thank you everyone for joining. Happy holidays, happy new year, and we'll talk to you in 2025.